This is the Texas Land Guys podcast, hosted by brothers Tim Dosch and Tom Dosch. With their partners David Marshall and Trip Rich, they have built DMRE, the leading land brokerage in Texas. With decades of experience brokering deals between landowners and real estate developers, they take you inside the deals that move the market.
All right, Tim. Well, another podcast episode. How are you doing?
I'm doing good. How are you?
I'm good. I think it's been busy. I guess being busy is a good thing, though. We got a lot going on, and this podcast is kind of a fun break from just everything we're doing with our brokerage business and investment business and nonprofit, and then just deals that we're working on. So it's a good excuse to get to spend a little bit of time catching up with you. So this is good.
Yeah. So this is, I think, my 22nd year in the business. And this might be the busiest start to the year I've ever seen. I mean, just with how beat up the market's been the last 2 years, everything just seems to be coming together for a really good 2025. And just with our business and both our businesses, there's a lot of things moving and some exciting things happening that have kept us really busy.
Yeah, I think what feels pretty good is we survived to 2025.
That's right.
I remember hearing that I think it was late 2022 or maybe it was early 2023, and it seemed like forever when they're like, survive to 25. Unfortunately, we did a lot more than survive. We actually had, good last couple of years, but I think we're positioned, like you said, this year to experience an incredible amount of growth, and our team is stronger than it's ever been. We feel probably better about the team that we have than we've ever felt. And we've invested a lot in technology over the last 24 months, just investing into what we knew was going to be just a huge ramp up. And so kind of we're firing on all cylinders like we never have before. So pretty excited about this year. And I think 2026 will also be a very, very busy year.
Yeah, it's a good point because, I mean, this has been a tough run in 23 and 24. And so you might hear that and think, well, man, it must have been like very few deals closing. But I would say probably we closed around 200 deals, or somewhere in that range, 180 to 200 deals over what was a very difficult time to close deals. And I think a lot of that has to do with the team approach and just some great clients and understanding the deals that could get done in an environment where deals were tough. But now I think things can really open up and we could see just a lot of deal volume and a lot of movement on pricing and big developers and the big money coming back into the Texas market.
Well, we're still early on in this podcast, still making our way through this, understanding how to do this together. It's been fun so far, just recording the episodes that we had. And I think that for today, we were thinking a good just foundational episode for the podcast is talking about misconceptions about land. We've chosen to be land brokers. We've chosen land, for our careers. And I think that, a lot of people interact with land all the time, but there's some really key misconceptions that people have. And so I think it'd be fun to go through what we think might be a couple of the big misconceptions that probably developers and landowners and, people just have about land.
That's right. And I think when we were talking about this, kind of going through these, maybe more specifically misconceptions about land values, both from a development and investment standpoint. But when people think about land that they're going to buy or maybe the land that they own that they might want to sell, some misconceptions about it.
What do you think would be one of the first ones that comes to mind right away that we hear all the time that, antenna goes up and okay, we know from being in the business that that's just not the way it is?
I think these are almost like they're probably things that people think are truisms, that this is true. And they're almost like cliche kind of statements that people make and people accept and just believe without even thinking about them. But the first one we had was that land always appreciates. And the idea that if I buy a site, or if I've owned a property and 5 years ago it was worth X, now it's got to be worth 20% more, 30% more, some big appreciation. And people might think, well, if inflation's, been, who knows what it's been the last couple of years, but let's just say we've had 30% inflation over the last 4 years and my property's gone up that much and probably more. And I think that the market is not consistent with how properties increase in value. And there's examples where we've seen properties that, 20 years later, 30 years later, are the same value or less than they were 30 years ago, which might kind of shock people. And that's not typical. I mean, that's not, I wouldn't say it's across the board, but there's definitely situations where, people have held property and the area has gone down. There's maybe some significant development hurdles that have never been figured out, and the value just hasn't gone up on that property. And so are you seeing that up in Dallas, Tom? Do you have some examples of some sites where you think the property should go up in value, but it hasn't?
Yeah, that's a great one. I think land always appreciating is probably the most common one, especially from just landowners. A lot of times people out in the suburbs that maybe even live on a property that is a larger property. And so they're just used to growth happening around them and feeling like land is always becoming more valuable. But yeah, so an example that I think comes to mind is there's a deal, a land deal pretty close in inner Dallas, not too far from where we office. And, back in the 80s, office development exploded and you had all these buildings built, an incredible percentage, of office that was developed in places like Houston and Dallas was developed in the 80s. And so land prices, and this is almost 50 years ago now, we're talking about 40 plus years ago, land prices were higher back in the 80s for sites around our current office than they are today, which is incredible because you think about pretty much any investment, and just natural inflation in a 45-year period. But there's a specific property where the value that they were offered for, real development about 40 years ago was about 30% higher than what they're trying to sell that property for today. And it's still challenging to sell that property today for a 30% discount off of that.
Man,
and
that's amazing.
Just that belief that, land is always appreciating. I think although in a lot of cases it is more valuable over time, once you're thinking about these areas where the growth hits the area, and I think you were using an example of Sharpstown not too long ago when we were talking, but there was a time when that was a part of town that was exploding. That was that also around the 80s or was that like the 70s? When
Probably
was that?
70s and 80s. Yeah. And then they basically got overbuilt apartments and it messed up the market. And there was a flight we're talking about a submarket in Houston. There was a flight from that market to a place called Sugarland, just kind of southwest, that had an opposite view of apartments, didn't like apartments at all, and really opposed apartment development. And that's actually still a pretty good area today. But Sharpstown hasn't recovered, and the values are not good in that market. It also reminds me of the Woodlands area, and specifically kind of by where the Exxon campus is. You probably remember, Tom, almost about 10 years ago now, Exxon was going to put their headquarters right south of the Woodlands. Woodlands is a great submarket in kind of the outskirts of Houston. The Grand Parkway was also coming through at the same time. And so it was almost like you just can't miss. I mean, this is going to be an incredible area. Values will just keep going up. We saw developers go build wrap product deals, structured parking deals in a market that was a suburban garden style market. And, all that belief of that value creation never really happened. Exxon went in, the Grand Parkway came in, groups paid some huge numbers for these properties. And then we had oil prices fall and, all the rents that were projected and this big, absorption of all these units didn't really happen like people thought it would. And now 10 years later, we're still seeing sites probably worth 30% of what they were kind of in that heyday, 2014, 2015, when all that news was coming in about Exxon and the Grand Parkway. So I think, these submarkets, they can be past their prime sometimes with Sharpstown, where it's just they were hot at one point, now that's over. But they can also have boom cycles where there's a time that you need to sell and take advantage of all these positive things that are happening. And it doesn't mean that the market will continue to get better over time. It may go to a different cycle and just kind of be flat after that.
Yeah, that's a great point. We talk a lot about the idea that sometimes what we predict to happen is a lot better than what actually happens. And I think that was a good example of the thought of all the jobs that were coming and the thought of all the growth was actually, better than when the jobs did come, because they did build their campus. It didn't end up having the impact that was expected because the supply that was delivered just outpaced the demand that really was there.
It could work in the opposite way as well. There's areas like the Heights that when you started in the business, land was probably $15 to $20 a foot. in the Heights, which is another kind of infill Houston submarket. It was very pioneering. I remember you doing a deal with JLB and our friend Eric Overton in the Heights, and there were hubcap stores, and hubcap stores or resale hubcap stores across the street. Very pioneering, kind of scary area. And fast forward 10 years, and these sites are worth today, 130 a foot, in some cases 100 a foot, so dramatic, multiple of the value. And there's some markets like that I believe in long term. I think the Heights will be a good market for decades to come. But I think when you're a buyer and investor, specifically thinking about being careful where you do a long-term deal. And then as a seller, thinking about, honestly, where do I stand in the cycle? Do I need to take advantage and sell now because my properties appreciate a lot, and not just keep thinking it's going to always go up in value over time?
Well, I think I have to say, the famous saying that we hear in the business all the time, pigs get fat, hogs get slaughtered.
Yeah.
That's the example of just holding out for this. You would have been happy with $5 a square foot. Now you're at $7, and now you're holding out for $9, and then you hold out too long, and now it's back to $4. And I think we've seen that. It's easy to think I'm going to be able to sell pretty quickly, and then 4 years later, that same land tract is on the market with the third broker and it hasn't sold. And so I think just understanding that there's so much more that goes into this statement of land is always appreciating, because I think, like you said, the cycle component of that is really important for a seller to think about.
Yeah, we've literally seen sites where sellers have been holding out for 10 years, trying to get a certain number, and then they can't get that number. So they just keep holding. And, in some cases they miss the market, and, things just don't get better. I think, not to just keep giving examples, but the Houston Galleria is like that. I mean, it used to be where you build all the high rises. It was a high rent part of town for office and multifamily. Now the rents have fallen for office. We're seeing foreclosures on office buildings in the Galleria. Multifamily rents are not strong. You really can't justify new construction, but you still have sellers that are wanting pricing that we saw, 7 or 8 years ago. And honestly, I don't know when that pricing will come back. Maybe someday it will, but you could be waiting 5 years or 10 years for that. It's pretty unpredictable when that kind of pricing could come back.
So I think another big misconception is that to establish value, you can use comps. And this is where maybe appraisals, get thrown around a lot. So I'll talk to a landowner. We'll be asked to do a broker opinion of value, our thoughts on the value of a property. And a lot of times they'll say, I just got an appraisal for $20 million, or 3 years ago, it was appraised for this much money. And I think, what's so interesting about that is, that's a really hard job that those appraisers have, trying to say this is the value of a property, because they're having to use historical data. And the way that we really look at land is not so much what happened historically. An example would be that 1980s office development site, here in Dallas. That's not an office development site anymore. So yeah, you could say back in the 1980s, that site was worth $90 a square foot. Today, it's really not worth that, or even close to that for office. And a lot of times that shift is not, it's not a 40-year shift. It's 6 months ago, a property sold for $12 a square foot. We know that we're closing a property now, maybe 2 miles away, maybe right next door at $18 a square foot. Or maybe it's even gone the other way just because of something that happened in the market. And so I think that's a big misconception, that what are the comps in the area and that's what my property's worth, or what is an appraiser saying my property's worth at this point of time, and then I can turn around and sell the property for that value.
Yeah, that's a great point. I feel bad for appraisers because they have a hard job, and I know you help them out, and I help them out a lot. They'll call us and trying to make a case for why something's worth, or why a site's worth what it is. I think a big difference is they're always trying to look at what happened in the past to say what something's worth right now, and we look at it what's happening now, what will happen in the near future, and that's what we believe the value is. And so it's just a different way of looking at value. We would try and see what we believe is more reality. They're having to try to use empirical data to back up what they're saying. And it's just a very difficult job, especially on some sites where there's just not a lot of good comps. But I think that what we do look at instead of comps, even though we'll consider comps and they do have value, we look at highest and best use. What use will pay the most to be developed on this property, and is that achievable? Is that a use that is active right now? Is there capital for it in the market? Kind of running through the potential uses and what they can pay, and just the transaction risk of working with one of those developers to do that deal. That's kind of the forward-looking view of value and how we come to a number that we think makes sense.
Yeah, that's a great point. And even within highest and best use, and I think we talked about this on a previous podcast, you have something like maybe, apartments or, single family. If the developer can deliver a product at a lower cost, or if the developer, maybe like we've seen a lot, there's a lot of developers from out of state, developers that don't have projects, but they have capital they need to spend. They may be a little more likely to come and pay a little bit of a premium just to control a property or even to plant a flag in a market. And so a lot of times we'll market properties, we'll get 10, 20, 30 offers, and you'll have groupings of where developers end up on price. And it has so much more to do than just what they're building, because it could be 20 offers from an apartment developers, but the cost of their capital, the cost of the project, how aggressive they're willing to be in this point of time, how bad they need a deal. And all of that is, you really can't just use a comp. Like you said, a comp is just kind of another leg of the stool that we use to kind of right size everything, but it's not really a driving factor on what a property is truly worth.
Yeah, great point. So I think the third one we have was, but this is definitely a cliche and something you hear people talk about is, land is always a good investment because they're not making any more of it. I've had a lot of friends tell me that before. I think the idea is you can just go buy any site. It kind of a little bit goes back to our first one that land always appreciates, but this idea that there's this finite amount of land. And I've met a friend when I started in this business 20 years ago. He's like, well, that seems like that's not a very good business, because what happens when you sell the land? How are you going to do deals if there's no more land? And the reality is there's always more land. There's a lot more land than people think. And different land has different values depending on some key characteristics. And a lot of that goes back to what land can be developed and what kind of use can be developed for. If there's a scarcity of a certain type of land, like if there's a zoned market like Dallas and you can only build so many apartment deals in that market, and there's a real true scarcity around that, then I think that land has an incredible value and it can keep going up in value. But if we're talking about just general land, farmland, ranch land, large acreage, there's all these cities now, Dallas and Houston, Austin, San Antonio, you have these massive expanses of city that are, on 100 miles across, 200 miles across, just massive footprints these MSAs cover now. And there's all these areas where you see redevelopment, sites being torn down, old malls being torn down. And we're selling something like that right now, old office buildings being torn down. So you're constantly creating new land, so to speak, through those types of things. And so you have to have a little bit more sophisticated way of looking at it than just thinking, well, it's land, so it's gonna keep going up in value.
Yeah, that's a great point. And I think that I feel for land investors that maybe just don't really fully understand the business, because there's so many things that can catch you on land. And, we've been in the business a long time. We've done a lot of deals. We've bought a lot of properties on our own behalf. And, the analysis that we're doing whenever we're looking at an investment property, or when we're helping a landowner think about the value of their property, there's so much risk there. And a lot of times the biggest risk is really just the market risk of what's going on in the overall market. But there's also the risk of floodplain. There's a risk of environmental impact. There's the risk of, you might be in the flight path and have a height restriction. You might not have adequate sewer capacity. You may not be able to get sewer at all. You may not have water capacity or be able to get water. You may have drainage issues. You could be, like I said, in a floodplain, but in a place like Houston where that's almost going to just debilitate the ability to do anything. Yeah. And so there's so many different boxes to check and things to think about. And then if you check all those boxes and you have a site that, has utilities, maybe it's flat, it's got detention off site, it's just a good development site, but then there's not demand at that point in time for what would get built there for what the highest and best use would be. You may not be able to sell that property for 5 years, 10 years, or the growth, if a classic land investment would be, in Dallas, it's always growing north. We're growing to the Oklahoma border. It's already really, the growth is there. So just go plant a flag somewhere in between, the McKinney market and the Sherman market, and you're going to be safe. Well, what if the growth goes around you, or what if the infrastructure, the roads and utilities just take a lot longer to get there and they go somewhere else first? And so as an investment, land can be a really dangerous investment. I think we've seen that with foreclosures, especially recently. We're tracking way more for foreclosures right now than we've ever tracked before. And a lot of that is because investors felt like the market's going to continue to run and land's a good investment. And then, we're going to be really aggressive. We're going to put debt on land, which basically is, I think we believe that you've pretty much sealed your fate once you put debt on land as an investor.
Yeah, the timing for the market has to work perfectly when you do that. And I think one of the big risks on these sites is these municipalities, which you've had a lot of issues in the DFW area with that, where they're coming in and trying to stop development, trying to put moratoriums on new development or on utility capacity. We've seen some of that in Houston, some of the kind of smaller states surrounding Houston, where they'll just say, almost on a whim, no more multifamily, or we have no utility capacity for 2 years. And so you're seeing rapid growth in some areas, but then you can't, if you're holding one of those sites and there's no utilities, you really can't sell it for a good price. It'd have to be a pretty low price to be able to sell it. Or if you thought you could build multifamily on it, now you can't build multifamily on it. Maybe you have to do a single family use or a different use. That might cut the property and the value in half or by 30 or 40%. So really understanding some of the nuances of these different factors that affect value is very important.
Well, and right before I got into the business, you and David were really focusing on these note sales during the Great Recession. And so that's a great example of land is not always a good investment. So, but what are a couple of examples of what you guys were running into? Because at that point, that was pretty much all there was to work on as a land broker, was just people that got into trouble.
Yeah, a lot of what happened in the Great Recession was, and we're actually starting to see this happen again. You had a lot of single family development, lot development. So all these lot developers are getting very aggressive, and the banks are being aggressive lending to them, putting debt on these lot development deals. And unlike today, at that time, there was an oversupply of lots, a significant oversupply of lots. And so all of a sudden, everything crashed, that nothing was really trading. The banks were not lending on lot deals anymore. And so those deals had to be sold really cheap because it became all cash deals. And so we saw a long period of time where it was hard to get debt from banks for land deals, especially lot development deals, because of how bad they gotten hurt in the Great Recession. Yeah,
that's so interesting. I think I'm glad that I didn't start during that time. So fortunately, I was at Texas A&M, and then I was in investment banking. But it's getting to start in the business in 2012, coming out of that, was, of the last 12 plus years, that was one of the hottest land cycles that we had coming out of the Great Recession.
Yeah, the Great Recession was very difficult. It was one of those kind of almost scarring experiences that I'm sure everyone that went through it doesn't want to relive it. But it was also the best teacher that probably any of us had that had to live through that, just because of how hard it got, how you saw, different developers or investors, even brokerage shops that were leading in the market, were very successful, had a long history of success, really could do no wrong. They completely failed. There were brokerage companies that were market leaders that went out of business. There were developers who went out of business, investors who lost tons of money. It really reshuffled things and changed things a lot. And then there's also a lot of great developers that started, coming out of the Great Recession. There was a lot of money made on good buys through that. But those, we always tell, the young guys that work for us, those hard times, they're really not fun, but they're also the best thing that could happen for your career, because surviving those and learning the lessons of the difficult times make you a much better broker. You see, both sides of the business, when it can be good and when it can be bad. And you really learn a skill set that helps you be that much more successful when things are good.
Well, and then I think the last misconception we were going to talk through is just this idea that selling your land, if you're a landowner, is kind of like selling your home. It's almost the idea that, and I don't know if anyone would say this, but I think it's the operational belief that land is a liquid asset, which I think we know that it's not, and most people would agree that it's not. But then we run into this all the time where, we just had this yesterday on a deal here in Dallas, where it's more of a suburban location. And so it's a family that owns large acreage, but they have a home on it. And so they hired a realtor to sell it. And the realtor wants, a 30-day close at a top of market developer value on a site that's not zoned. And the comment was, well, we're selling a house. And, the truth is you're selling a house. The house is worth about 20% of what you're asking.
Yeah.
And so if you want to get this 100% value, it's not going to be liquid. There's a lot. There's going to have to be confirmed utilities, confirmed zoning. That's going to take time. And so the biggest challenge with land is if your investment thesis is I have to sell by a certain date, you might check a lot of boxes, but then the market could move. And then it may be very difficult to sell without taking a significant loss.
Yeah, sometimes you have to perfectly time the market. I think people look at, almost would liken it to looking at it as like it's a stock, and there's like a sell button, and you just hit the sell button, and if this is what the property is worth today, that's what I get. And it's literally the other end of the spectrum as far as difficulty from that. I mean, there's been, especially on some of these really high profile sites that are, challenging deals, some of these infill deals where we were trying to really just like high point the market, set a record price, like how hard the job is of just like threading the needle, needing to get, all the buyers to submit offers, having like the perfect, kind of, battle back and forth where these buyers are trying to beat each other out and really stretching on price, and then having to have the market just be at the perfect place where there's lots of capital, there's a very bullish environment, everybody's underwriting, crazy rents and all these assumptions. All those things have to come together to get this price that then becomes this market leading price. And I think a lot of sellers will take that for granted and just assume, man, if this is a good site, then I should just be able to go sell it. And there'll be, anybody would pay that price for it. The reality is maybe 5% of the buyers would pay that price for it. And maybe they'll only pay that price for a short window in time that's like a couple months. And then the market shifts enough where that's no longer reality. It's a lot different than the way people would typically think. And a lot of it's because these deals are very unique. If someone's going to go build a $100 million project on your property, they're looking at it differently than someone who's going into a neighborhood and saying, all right, there's 8 houses for sale. I'm going to go look at which one I like the best and make an offer. But there's a lot of similarities, and the values are going to be somewhat close, and we can look at kind of price per square foot to the building, that kind of thing. Land is just dramatically different from that.
Yeah, that's a great example. And what I would say for what we've seen this last year up here in Dallas is a lot of what we've worked on have been developer-owned properties, because you had developers that in a lot of cases, they bought a property and have a pretty good basis in the property, but maybe they bought several properties and, now they're going to sell off a few to maybe then go try to recapitalize and go develop the others. But what I see a lot when it's a developer-owned property and they've decided they're a seller is maybe for one reason or another, they're not going to build it. It doesn't work for them. But then they're going to require the buyer, another developer, to operate on a much faster timeline than they would ever operate. And we both know that there's plenty of developers out there that it's an option contract. They'll tie you up for a year and not close. But there's also really quality developers that if you gave them the time, they'll get it done. And we know they'll get it done. But the seller's position is, if they can't do a 60-30 or a really quick timeline, we're not going to accept that offer. We're not going to treat that as a real interested party. So then you start fast forwarding. So then 3 months later, 6 months later, 9 months. Okay, now it's been 12 months. Now I'm marketing the site again. And now again, I'm getting the same feedback. I think we could have been closed by now if we would have given a quality developer time to go perform. And I know we've seen that time and time again. Developers a lot of times make really interesting sellers, because I feel like a lot of times developers put a lot more and require a lot more of the buyer than maybe is always realistic. And so it's a hard job for us, because we have to try to educate even developers a lot of times as sellers on this is a reason why you need to give this group a due diligence period. Give them time. We've seen them perform. We know that, their offer is different than the next guy's for this reason. But you're smiling. So what are you thinking?
I'm just thinking of how ironic it is. We've seen that so many times where, I think it's just which seat you're sitting in. You have a different perspective, and that's why it's been helpful for us. Being a broker and kind of being in between buyers and sellers, and representing sellers in some deals, buyers in some deals, but then being a buyer ourselves and putting hard earnest money up and paying all cash for deals, having to close fast on deals, taking risk on different issues with the site. and then being a seller and, trying to get a deal closed, having issues we got to work through to get the deal closed with the buyer. There's a lot of value in seeing those different seats, but it's almost funny working with some of these developers when they're in the seller seat, because we've heard them so much complain when they're a buyer, these sellers are crazy and they want me to put up hard money so fast, or they think they're asking this price and it's ridiculous. It shouldn't be that much. And then how many of these guys, when they're on the sales side, they're like, they just need to put up hard money. That's what we do. We put up hard money all the time, or we close really fast. I'm like, you don't close fast. What are you talking about? You're going to ask someone for 9 months. You're asking like someone's going to close in 60 days with you. So I think it's just kind of human nature, that we tend to, expect the best from other people. But then when we're in that place, we don't want to give people our best.
Yeah, no, I'm thinking of a lot of examples as you're talking, but I'll keep it to just thinking about them. I was going to say, as we're wrapping up this episode, we could do a whole nother episode on how we look at valuing land, and I'm sure we will. We'll probably do a whole series on that. But really quickly, when we're buying land, there's a couple things you said, so I'll restate them and then add on to what you think I'm missing. But when we're looking at land as an investment and we're thinking about appreciation, we're looking at comps. We're thinking about, is it a good investment at the end of the day? I think something really important you just hit was we always are buying our land investments all cash. So we're really thinking about our carry costs. So all cash is probably the most significant thing to think through there. And then a lot of times we're able to get an ag exemption on a property. We're able to step into a property that has a current ag exemption, so we can continue to, whether that's run cattle, do hay, have a bee farm, whatever it is. And so for our sake and our investors' sake, we're going to do the best job we can of timing the market. But what I want our audience to hear is, we can't always time the market perfect, and they know that, right? So what do we do to protect ourselves, knowing that we fortunately have done a really good job of timing the market really well, but having an all cash purchase, low carry costs, and really focusing on our basis is a really big part of, as an investor, being set up for success. It's set up for us and our investors.
Yeah, I think that, one of the big things is we're very careful about underwriting a lot of appreciation. We do believe that the submarkets we're buying in, the types of sites we're buying, because we're buying sites that we believe are great development sites. So we think that they will appreciate, but we're very sensitive to getting a good basis on the way in and creating value on the way in. And then if you get helped out by appreciation in the market, that's great, but you really want to make your money on the buy. And then really the experience of the Great Recession and several of the cycles, in Houston, we've experienced it on the brokerage side over the last 20 years. We've seen land at times when, you couldn't move it, you couldn't sell it. The capital went away for a short period of time. Normally it's only 18 months to 2 years. It's not like an extended period of time, but if you're sitting on land with debt on it, it's a scary place to be. And your basis can go up really quick. Like you said, if you're an ag, then your taxes are not going to be very high, so that helps. But if you have to pay taxes, if you're not an ag, you're going to have some pretty high carry costs from taxes, especially in Houston with some of the MUDs that we have that are really high tax rates. So we're very sensitive to carry costs and to thinking about, we think we can go sell this right away and make a lot of money, but it's crazy the number of deals we would have said that about a site, and then something dramatic happens in the market. And before you know it, it's been 3 years. And, the market, that submarket or maybe the macro market has stalled out for one reason or another, and you've had to sit there and wait. And eventually it comes back, but you weren't in a position just to sit and pay a loan and pay taxes and let your basis run up while you wait. That's not a good way to be.
Yeah, no, those are just key things I think we've learned and seen. And it's sad right now just to see properties that have gotten foreclosed on, and just see the trouble that people got into, and putting significant leverage on land. It's sad when we run into it and see it. But this was a good conversation. I think these 4 misconceptions are things that we run into all the time on land values, and so hopefully everyone learned something today. Had some good conversation with you on this, Tim, and I think that be fun to do this again next week.
Yeah, looking forward to it. Great conversation. Thanks, Tom.
Thank you for listening to our podcast today. If you have questions about land you own in Texas, send us an email at texaslandguys@dmre.com and follow us on LinkedIn to stay updated.